For decades, corporate dealmakers had a reliable trick for making massive, expensive acquisitions look absolutely flawless on paper. They utilized an accounting line item called Goodwill. Under the old rules, Goodwill acted like an expanding sponge on the balance sheet. If a company spent millions on transaction fees or planned expensive corporate restructuring, those costs didn't immediately drag down their profits. Instead, they were legally swept into the Goodwill calculation, keeping day-one financials looking pristine. The obvious danger was that this practice masked the actual economic reality of a merger from the people buying the stock. Investors saw healthy income statements, completely unaware of the liabilities quietly piling up in the background. The consequences of this transparency gap are perfectly captured by the AOL-Time Warner merger. When their inflated intangible assets finally collided with real-world performance, the company was forced to report a staggering $53 billion impairment write-down. The scale of the destruction proved the old accounting rules were a liability. Regulators responded with a revised set of business combination rules designed to give investors a highly accurate picture of a deal's economics. But by forcing companies to show their true hand, these exact rules created a massive headache for the investment bankers trying to model future acquisitions. The first challenge in modern deal-making revolves around the cost of getting the transaction done. Historically, fees for due diligence, auditing the final accounts, and negotiating the deal were completely capitalized. This means those expenses were legally added to the final purchase price and safely buried within the Goodwill line item. Under the new rules, these services must be expensed directly through the income statement. The only major exception is costs for raising debt finance. Those specific fees are still deducted from the issued instruments and amortized slowly over the life of the debt. For a banker, this immediate expense requirement is a serious hurdle. It physically drags down the parent company's reported group profits in the exact year the deal is struck. Demonstrating to shareholders that an acquisition will immediately boost earnings is now significantly harder. The complications expand when we move from the income statement over to the balance sheet. Specifically, the way we handle non-controlling interest, or NCI, which is simply the portion of the acquired company that the buyer doesn't actually own. This formula shows how goodwill is calculated under the revised standards. You take the price paid, add the non-controlling interest, and subtract the fair value of the acquired net assets. Officers can measure NCI traditionally or at full fair value. Choosing fair value means the larger NCI input forces the goodwill output to grow by the exact same amount. The equation balances, but final balance sheet numbers are noticeably higher. This choice physically inflates the size and shape of the post-acquisition group balance sheet, creating a dangerously swollen financial profile. While it doesn't change the actual cash value, a swollen balance sheet directly impacts the specific financing arrangements and debt covenants bankers rely on. The most unpredictable variable introduced by the new rules comes into play after the deal closes, through something called contingent consideration. These are future price adjustments, often structured as earnouts that trigger only if the acquired business hits specific performance targets. In the past, if a company had to adjust its estimates for these future payouts, accountants simply went back and tweaked the static goodwill number on the balance sheet. This graph maps out the new reality. Any adjustments to those future earnout estimates must now bypass goodwill entirely and hit the group income statement directly. Because these estimates constantly shift based on the chaotic, day-to-day, real-world performance of the recently acquired business, it is structurally impossible for a financial modeler to completely eradicate this volatility from their forecasts. This creates a unique dilemma. A merger can be negotiated perfectly on day one, yet still introduce wild, completely unavoidable profit swings to the parent company's public reporting for years after the ink dries. We are left with a fundamental tension at the center of modern mergers. The underlying economic value and cash flow of a target company haven't changed, but the reported reality of the deal follows an entirely different set of mechanics. Because of these changes, the static M&A financial models that bankers relied on for decades now require significant re-engineering to stay accurate. This table shows the complex adjustment columns required to reconcile the individual company data into the finalized group balance. Investment bankers must now build dynamic merger models with programmable switches to instantly test both non-controlling interest measurement methods. Looking at the final group balance total figures, we can see exactly how dense the post-acquisition math becomes. With the incoming threat of contingent consideration volatility, deep sensitivity analysis is critical. Bankers have to meticulously predict the post-acquisition performance of the target to ensure their forecasts are sound. Executing a successful acquisition today requires both a competitive purchase price and a financial model designed to withstand the high level of disclosure required by these accounting standards.